The S&P is less than 30 minutes away from its best two-year return since the late 1990s, but has more market volatility on the way in 2025 with global policy uncertainty on the rise. Let's ask Joyce Chang, chair of global research at JPMorgan. Joyce, it's great to see you. Really glad you could weigh in here. I'm thinking back to 12 months ago, and one of the big talking points looking into 2024 was some huge majority of the world was going to be going to the polls, and there's going to be the possibility of these kind of sweeping policy reorgs around the world. I guess we've gotten a lot of that. I wonder what you think now the implications are of all of it.
Oh, it's great to be with you. Happy New Year's. Well, I think it's still a story of U.S. exceptionalism. And what we're seeing is greater uncertainty in Europe, and that we still have elections that are coming up there at the national level, votes of no confidence. We've had the surprises that have come out in Korea as well recently. But, the geopolitics haven't changed the overall dynamics, on the macro side. The U.S. remains the global engine for growth. There are still a lot of reasons why the S&P 500 is going to be favored over other markets, even though we're seeing a less certain and more cautious Fed here. So we've seen the electoral uncertainty, some of that which will persist in Europe and in some other countries, but many fewer elections going into next year. I think the focus will be on the U.S. market, and particularly just what types of regulatory actions might be taken that would facilitate more market activity, as well as more discussion also on the fiscal outlook as we get further into the year, however. And that does remain a source of uncertainty.
Yeah, I guess aside from, the newly elected government, you do mention that the Fed, may be keeping rates a little bit steadier than we thought a little while ago, so maybe only a couple more cuts. And then that could create the possibility for divergences with central banks around the world. We already have a very strong dollar. We don't know what the implications of tighter trade policies might be. So does this all go into the category of, things to keep on your screen but not trade off of, or do you think that they have direct investment implications?
Oh, I think you're going to see some direct investment implications. Look, we do see that the Fed will pause in January and then continue in March, but other central banks are going to have to move rates lower. At the ECB, we see policy rates going to 1.75%. So you could see euro-dollar cross parity in the first quarter of the year. So stronger dollar, weaker emerging markets, FX, euro-dollar crossing parity as well. So there are clear implications. I don't think that you're going to see as much policy rate cuts in the U.S. as some had anticipated. And we've been in the camp that thinks it is, high for longer is something that's here to stay. And that probably inflation is stickier here, as well. So I wouldn't just say it's about the Fed's path. It's also about the growth outlook. And we've seen such solid U.S. growth compared to other parts of the world.
Is there any room, do you think, for playing some kind of a catch-up trade in terms of areas of the global markets that have been either underperforming or underexploited, or essentially where you might see some kind of convergence? I guess what I'm getting at is you mentioned all the reasons for continued U.S. exceptionalism, and it feels like the markets have already been positioned for that scenario for a while, and I wonder if it pays to bet against it on any level.
I think it still pays to be diversified. We remain and have had a call to remain overweight in Japan, where we do think they're going through structural transformation here. And we do see the BOJ hiking rates in January. On top of that, you have all of the corporate governance reforms that are going on, the exit from deflation, and also consumer spending and wage growth. I think the UK is going to do better than the Eurozone. They also have a fiscal stimulus program in place that means that growth probably should hold in better here. In emerging markets, I think you have to be very selective here. But some of the markets that do stand out, Turkey and Argentina are two markets that have stood out. There's been a lot more caution, on Brazil and on China, and the focus is going to continue to be on tariffs. So just going back to the U.S., I think there has to be much more selectivity within the sectors as well next year. We still think Mag 7 is going to do well, but we would also be more diversified and looking at greater dispersion across sectors, across countries, and across themes next year.
And does China, its economy and markets, does it remain on the defensive going into next year because of all those factors? Or, again, is there room to feel as if they might be able to kind of get the policy mix right?
Look, our base case scenario, we do have an increase in tariffs to 60%. So that is a meaningful decline in China's growth from the 5% target they have. We have growth just under 4% in China right now. I think that China will continue to put in both some more monetary and fiscal measures into place, but the structural problems related to the property sector and also consumer demand remain there. But you do see a really strong export performance right now. But I still think this is going to be a difficult year for China and emerging markets more broadly, where you could continue to see outflows, just given the U.S. exceptionalism, that's still high rates that are going to attract capital, and then the threat from tariffs as well.
Yeah, you mentioned the high rates in the U.S. on a relative basis, and perhaps that's attractive to global capital flows. Do you see that at all being in question if there are more questions about the fiscal situation in the U.S., or you feel as if that's just going to be supportive of current, sustained deficits here?
Well, I think you're going to see more capital market activity, but the concerns about the deficits are not going to go away. And you could see some signs of that as well. Just you see the debt ceiling debate is going to heat up. We've even seen in the government shutdown, they're going to have to make some difficult choices. And market expectations could be getting ahead of themselves with respect to what really can occur with deregulation and with tax reform. So I think that is going to be more of an issue when we get towards the middle of the year. But for right now, the growth story is still one that is really differentiated in the U.S. compared to the rest of the world, particularly when you look at the strength of consumer spending in the fourth quarter of the year that was still around 3%, and some of the investment flows that are coming in and reshoring flows that continue to come back to the United States compared to other countries.
Yeah, absolutely have some momentum in that direction. Joyce, great to talk to you. Thanks so much, and Happy New Year.
Happy New Year's.